Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. Today we're talking about the apartment market. The multifamily industry has certainly been hot. Speaking of hot, I have some industry giants here today. John Isaacson with Preferred Apartment Communities. Thanks for joining us today.
Certainly. Thanks for having me, Mike.
And Mike Altman with Cortland Partners. Thanks for joining us, Mike.
Good morning.
Well, guys, we heard a little bit about the kind of the worldly view of the market. What do you see for demand in some of your communities? Mike, if you could start us out, what do you see for demand in your properties?
Well, demand has definitely improved over the last 3 years, and I think the most important shift we're seeing now is that the quality of the renter pool is really increasing. The average age of our renter is up 10%, or like 3.6 years. So 3 years ago, we were renting to 34-year-olds on average, and today it's 37.7 years old. And that average age increase brings along with it a larger income. So our rent-to-income ratio has improved like $8,600 a year. So we're renting to a higher income and a older clientele, which is really improving our sort of ability to move rents and sort of the stability of our rent roll overall.
And share with the listeners, if you will, a little bit about your portfolio. What types of communities?
Cortland Partners owns 19,000 apartments throughout the broader Southeast, so that includes Texas. Mm-hmm. And we're really in a B to A space, focused in on a value add. So a lot of our properties are built in the 90s or early 2000s, and then have undergone a significant renovation to the interiors and amenities and exterior of the property. So it's a high-end product at a slightly reduced rent to new construction.
Okay. And John, to get us started, tell us a little bit about your portfolio so the listeners have a perspective of where you're coming from.
Sure. So Preferred Apartment Communities is a publicly traded company. We're actually on the New York Stock Exchange on the new marketplace. And our portfolio is primarily focused on core assets. We're newer construction. We actually have a mezzanine loan program that funds directly into development. So our assets would be slightly newer and a little more of a core asset than what Mike was describing.
And what are you seeing for tenant traffic and demand in those core assets today?
I think Mike said it very well. Over the last few years since the housing crisis, as home ownership has declined in the U.S., we've gone from almost 70% home ownership in the country to less than 65%. And every time home ownership drops 1% in this country, you create about 1.1 million rental households. And, not all of them are going to come and rent apartments. They're going to move back in with mom, they're going to double up, maybe they rent a house. But the market has definitely benefited, the apartment market has benefited from that rental household creation. And we see better incomes, we see better renters, we see more stable tenants, and certainly I think our retention's gone up, and as retention goes up, it's a lot easier to push income.
And what do you guys think are the factors that will affect the apartment market performance moving forward? Like you mentioned, housing and how a lot of people are renting. As the housing market improves, how do you think that'll affect especially the core assets?
I think as housing improves and as housing gets more expensive, depends obviously on how apartments keep up in terms of the cost, but I think as housing gets more expensive, it creates more renters, especially at the younger end of the spectrum, those getting out of college, and even in their first or second jobs. I do think that housing growing, it's different market by market. If you're in a core market like a New York City or a Chicago or a San Francisco, that's a very different calculus than San Antonio or Oklahoma City, where even though housing may be growing, may be getting more expensive, it's coming off such a low base that it's still very competitive with the rental pool.
And that makes sense on the longer term. But I would submit that currently the U.S. economy is pretty tepid. I think we just posted like 0.1% growth in the first quarter. We all expected like 1.2% growth. So I don't believe that there's a lot of wage growth or income growth happening on the macro. Jobs are still scarce or difficult for a lot of Americans, and so that's constraining a household's ability to move on to the next type of housing, to a for sale or a single family product, which just results in a longer term renter. We are in the business of space over time. So if a renter was 2 to 3 years 5 years ago, and today they're 3 to 5 years, that produces a lot more. That's a lot more demand, on the aggregate.
Yeah, and we're short on the break, but John, what do you feel about new supply, and how's that affecting? Are you seeing the effect in some of your markets?
In some markets, certainly. I think new supply has grown, and if you look at the growth percentages, they're huge, but they're coming off such a low base, a post-World War II low, since the Great Recession in 07 and 08. I mean, in 09, I don't think we delivered 72,000 new units, which is just microscopic compared to historical averages. Today, we're at or just above on a national level historical averages. In some markets like Washington, D.C., San Jose, Denver, you're seeing a lot more new supply where it's more problematic, but overall, the market's still relatively healthy.
Okay. Well, stay with us. We'll have more on the apartment market, including the investment market. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you in part by your friends at Bull Realty. When your business requires proven performance, visit bullrealty.com or call 800-408-BULL. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. We have some interesting shows coming up for you. Check out our show website for upcoming show topics. We've got one coming up on mixed-use development and a show on the U.S. industrial market. Stay tuned for those shows. And today we're talking about the apartment industry and the apartment market with John Isaacson with Preferred Apartment Communities and Mike Altman with Cortland Partners. And gentlemen, you guys have been acquiring properties. You're out acquiring properties. What do you see for available acquisition opportunities right now?
Well, it's a very competitive market. I mean, these fundamentals aren't like a secret that John and I have. It's it's widely known that
the secret's out.
that this market and this investment class has a lot of robust fundamentals behind it, and so therefore there's a lot of people entering the market. I think there's a lot of big capital pushing to get into the space, and so that's making every property that's on the market have 3 or 4 times as many bids as a few years ago. Specifically to Cortland Partners, we have a value add strategy where we're purchasing something, fixing it up, and repositioning into the market. So with that perspective, or that that business plan, we're able to look at a lot more types of assets. Sometimes they're in the 80s built, sometimes they're 2000s built, and it's not necessarily the same perspective on the project as all other bidders. So we may see an opportunity where other guys are really just looking at the in-place yield of the asset.
Okay. And John, you guys are a little bit more in the core assets, right? What do you see for acquisition opportunities?
No, I agree with Mike. There's so many more bidders today than there were 2 or 3 years ago. There's private capital, institutional capital. We see other public companies, both our size, which is smaller, and then some of the larger players. And it makes it harder. It makes it harder for the numbers to pencil out, and it really depends on your cost of capital. I mean, whoever's got the lowest cost of capital is going to be able to price the same yield a little better.
And you're looking at for core assets, but not necessarily core markets, right? Tell us about that.
Thanks. I think that's a great question. For us, the core markets, which are really the big gateway cities, New York, Boston, Chicago, San Francisco, the cap rates have gotten so low there. There's so much institutional capital chasing the deals. They've driven the cap rates down, sometimes below 4%. And as a yield company, as a dividend-based company who's looking to return to the shareholders a solid yield, we just can't make that work. So we buy the higher quality assets in those primary and secondary markets that are really outside of those gateway sort of bi-coastal cities. We like markets like Atlanta and Dallas, Oklahoma City, Orlando and Tampa, Raleigh and Charlotte and North Carolina, markets like that are still strong, diverse economic drivers, big population bases, but just not quite as core and fundamental as some of the bigger cities.
Yeah, that makes sense. And the volume of sales has seemed to have really picked up in all types of real estate and investment properties these days. But John, what do you see for volume for you guys last year and then moving forward into this year?
Last year we had great volume both on our mezzanine loan program. We actually invest mezzanine loans in new development, and our acquisition program was robust as well. I mean, we are more selective, so we'll do 2,000 to 3,000 units a year. And probably next year we'll ramp up a little more on the acquisition side based on the strategy that we have in place. We're a little more bullish on our opportunities for next year, but I think for this year it'll be about the same as last year, sort of that 2,500 to 3,000 units.
And Mike, what about you guys at Cortland? What did you do last year for volume, and what do you expect this year?
Well, we were really blessed last year with both a great capital partner behind us, and then sort of expanding into Texas and Orlando with regional offices. So with a bigger team and strong capital, we were able to actually acquire about 10,000 units last year, which is just out of like $1 billion of total capitalization. That was essentially doubled the size of our overall portfolio. In 2014, we haven't taken our foot off the gas. Maybe we're trying to find third gear somewhere down there. And through July, through the second quarter, we'll have about 9,000 units added to the portfolio. There are a couple big projects, that are sort of 1,700 unit projects that are sort of chunky, if you will, on that in those numbers, as well as a big portfolio that's we've been working on for 3 years. So that's sort of unique. However, the volume is going to exceed 2013 in total acquisitions, and I think it's still a great time to buy. And our strategy is to continue to increase our portfolio until 2016, 2017, where we really slam on the brakes with both feet and sort of see where the economy sort of goes off the next edge.
Well, that's interesting. Well, what do you see for cap rates for some of the various property types that you're acquiring?
Well, I'm more focused on like a Class B property as an acquisition. In the very core markets, that John mentioned, those are going at 5% or less. And then in the secondary or primary markets, I think 6.5% is a great cap rate for those assets. Although that's sort of like the chasing the unicorn is kind of hard to find. The cap rate is in the eye of the beholder, and to argue a cap rate with somebody is sort of like a circular reference. To say 5.5 or 6.5, the reality is if there's a value add opportunity, the market is pricing that in and starting to really compress those cap rates, and then it really comes into what is the sort of stabilized opportunity, and that gets even wider volatility by the bidders.
Yeah. John, what are you seeing for cap rates out there?
Again, I think in the core markets that we discussed, they can be anywhere from sort of the high 3s to the mid 4s.
That's
which
amazing,
obviously, it hardly makes any economic sense for us. In the primary and secondary markets, we see anything from 5.25, 5.5, up to about 6.25, depending on the market.
Okay. Well, stay with us. We'll have more on the apartment market, and including financing, what we're seeing there. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back.
The Commercial Real Estate Show is brought to you in part by Florida International University. With FIU's Fast Track system, you can earn your master's in real estate in just 10 months without interrupting your career. Visit FIUonline.com to learn more. That's FIUonline.com.
Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Hey, be sure to check out Ask Michael Bull on Twitter each day. We post a video with a commercial real estate question and answer. We hope you like it. Well, today we're talking about apartments with John Isaacson and Mike Altman. And gentlemen, I'd like to talk a little bit about financing, which is a big part of any commercial real estate subject. What are you guys seeing for available financing today for apartments?
I think the banks, I think the agencies, I think life companies, the gamut have opened up their doors and are looking for available opportunities. They like the risk profile, and they're getting very competitive both on terms as well as interest rates. And we are looking a lot at we look a lot at variable rate debt, and that allows us to have more flexible prepayment and sort of buy the project, fix it up, and then put on permanent financing in, let's say, the second to third year. with a flat yield curve, I'm very comfortable with my interest rate risk on the variable debt. And I think that our economy has a troubled monetary policy that's going to force the Fed to keep interest rates low even longer than the chairman thinks or sort of indicates in her comments.
Now, what are you seeing for these value-add type properties, if you will, for underwriting and type of leverage that they'll allow, loan-to-value ratios?
Well, I've seen loan-to-value ratios pushing 100% of the purchase price, which is starting to show you that the market's sort of getting overheated, perhaps, and that to me is over-leverage. But at 70 to 75% leverage, I think you're seeing interest rates at 2% or below.
Mm-hmm. Okay. Wow. And John, what are you seeing in more of the core asset area?
Our investment horizon is a little bit longer. We're looking at 7 and 10 year hold periods for our debt. And so while the yield curve is flat for the next 2 or 3 years, there's certainly a sharp spike as you get out past 5 years. And we feel like the fixed rates today are so low, and we feel like that creates a ton of value for the asset over a 7 or 10 year period. And even if we did want to exit, and Mike makes a good point about flexible prepayment, but most of the loans we get are assumable. And so even if we did want to sell, we feel like that rate's going to be so competitive that it's actually going to add value to the property going forward.
Yeah, well, that'll be interesting to see if it does. And talk to us a little bit about Fannie and Freddie. I mean, they've always helped the apartment financing world, and some people are concerned about them. What's going on there?
There've been a lot of reform proposals over the last 12 to 24 months, and certainly Washington's very focused on cleaning up the books, and they'd like to see reform for the agencies, and they'd like to see the GSEs sort of revamped. Mm-hmm. The core focus is on single family, and I think what's important for people to know is that multifamily, as a business division of Freddie and Fannie, they never lost money. They would not have taken a bailout if it hadn't been for the problems that single family had. And one of the issues that we as an industry have tried to educate the folks in Washington on is that this is a viable asset. It's a viable asset for the taxpayers, and to reform is fine, but to eliminate is a mistake. It would hurt the economy. It would hurt certainly our industry, and it wouldn't do the government or the taxpayers any justice. I think the reform proposals that are in front of the Senate today are very comprehensive. There's some discussions going on right now, and it's possible we could have reform out by the end of the year.
Mm-hmm. I do want to comment. You think that Washington is interested in cleaning up their balance sheet? That seems to be like an oxymoron in a way.
Well, you would think, but there's a lot of folks in the legislature who are concerned about the depth and breadth of the government investments in the bailout post 2008, and would like to see those investments that the government's made, see that money recouped. And in the case of Freddie and Fannie, almost any way you look at it from a privatization standpoint, that's going to result in a profit.
All right. Well, gentlemen, thanks for joining us today. We appreciate you being in the studio.
Thanks, Michael.
And thanks for joining us out there in Radio Land. You're invited to join us next week. We'll talk about the industrial market. Don't miss it. So thanks for joining us. Be sure you lead, learn, and laugh, and join us next week for the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by Florida International University, Real Crowd, and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.